Hey, what's up? This is you guys say in China, right? We are back on it again. Let's learn. So in today's lesson, we're going to be learning about top to down analysis on Deriv synthetic indices, right? So if you look at this chart, you realize that this is on 8-hour time frame, right? You can't just wake up on any time frame of your choice and expect to get the best direction of that pair or the best trade from that pair, right? What you actually have to do, right, when it comes to top to down analysis, you have to go to the highest time frame possible that you have on that very chart. Then you start your study from there, right? So in this case, for us not to miss any move, right, or the bias of this pair, we have to go to the 24-hour time frame. That happens to be our daily time frame, right, on synthetic indices from the TradingView platform, right? So since we are in an uptrend, I suggest that we also just join into the trend of the market, right? Don't try to oppose the direction of the market. Just ride in the direction of the what? Of the market, right? I will explain the reasons why I'm saying we are in an uptrend, right? Also, there are other things that we have to see by your eye that can tell you the direction of the market, right? If you look at this chart, if you look at the moves that are going to the up direction, right? Let's look at them like that. This is the movement, sorry. These are the up moves that we have, right? From here to that point, right? This is the bullish move. If you look at the bullish moves, they are very fast and they have big candlesticks. Few big candlesticks, right? Few big candlesticks, right? That's one sign that tells you that those are impulse moves. I'm talking about these moves, right? From this point to that point, right? And from that point to that point, right? These are actually the major two impulse moves that we have in this market, right? Very big candlesticks and they are few, right? That's one characteristics of impulse moves that tell you the direction of the market, right? Then let's look at the corrective moves that we have in the market. If you look from this point to this point, the market was correcting, right? So a corrective move is very slow, right? Number one, right? And it is many candlesticks. That's how you identify the corrective move. So that's a corrective move, right? And if you look from this point to this point as well, you also realize the same characteristic, right? Very slow and many candlesticks, right? It hasn't actually covered the distance that we covered from this point to that point, but you're seeing that there are very many candlesticks. There are actually many candlesticks at that very spot, right? So that's a characteristics of a corrective move, right? So from that alone, I can tell that this is a corrective move and this is a corrective move. And what I expect after every other corrective move is an impulse move, right? So basically, what I can tell from what I'm seeing here is that we are in a bullish movement, right? We're in a bullish movement, right? So let's try to anticipate. Let me show you something here. If you use this bars pattern, right, from this point, wait, let me just mark from this point. No. If you use this bars pattern instrument, right, from this lowest point to the highest point like that, right, you see how they move like that. You can actually take this pattern, right, to this point, right. The distance is almost similar. It's almost similar on the impulse moves that you actually get on your instruments as you be analyzing, right. I'll show you other pairs on other lectures, right. So if you look at this point now, since we have a corrective move, our anticipation is that we'll get almost the same movement. So our targets will actually go to almost the same level as we have reached there. That's our targets for that. We expect a sharp move like this, all right, as we'll be taking liquidities that are actually lying within these ranges, right? All these highs, small highs that we're seeing there, that's liquidity that I expect to be taken as price will be going there, right? So let me just do the normal analysis that we are all used to, right? So from this point, you can realize that our market broke here. Remember, we said for our BMS, we expect at least two candlestick closes above a high or a low, right? So in this case, you can't argue with this one. This is actually a BMS. There are more than two candlesticks that actually broke that high there, right? Then you take from this one, where this high, it was never broken. It was only broken from this point, right? So you take it there. That's another BMS that you are getting there, right? Then the origin of the move that caused this BMS, it actually originated from this point. That's where it originated from. So this is our impulse move that is starting from that point to that point. But it actually mitigated this point, so I can actually take it from this level to that, right? They're actually sitting on almost the same zone there, right? So now if I'm looking at my demand zone, right? Remember what we said? We said after seeing our BMS there, wait for our corrective move, for our price to come back to our demand zone, right? So the demand zone that we actually have to take there, the demand zone that we actually have to take there, it's governed by this law. We take it from this law, right? But in the case, right, in the case that you have a demand zone that is there, and just to your left, almost in the same region, there is also a demand zone that is there. There is another law that is lying there, right? Many a times they will want to use this as a liquidity point. They might want to take liquidity from this point. So what you just do, you have to consider both zones that are lying there, right? It's a mistake that many people do, right? They try to be precise and they just consider this point alone like that. And they will realize that before price actually goes up, they will go slightly lower than this, hit their stop losses, and they will move, right? So if you are wise, what I will teach you, this I always explain to our mentorship guys. I once explained it there, right? If you have a low lying point that is closer to that point like that, right? What you simply have to do, just consider both zones like that. In this case, this is what you do, right? And we can just consider the order block that is lying in this point like that, right? Okay, it's fine now. All right, like that. So we can actually consider this as our demand zone, right? And expect to take our bullish moves from here. So this is where we are saying from that point, we are just expecting this same movement, this same price movement. That's what we're expecting. We're expecting that price will just move in this sharp manner like that, right? So this is what we're seeing from our higher time frame, which is the 24-hour time frame or the daily time frame, right? So now let's now step down so that we can see how we could actually get into these trades from this zone of interest, right? So what you can do, you can actually step down your time frames bit by bit, maybe from the 24-hour, you go to the 4-hour hourly time frame, and then to our lower time frames. That happens to be the 1 minute time frame, 5 minute time frame, and the M15 time frame, which we consider as our entry setup time frames, right? So from here, you can see an interesting fact that is here, right? Price was coming down, it created this high, then it created that low, then it moved up, right? Then here it gave a sharp move on the 4-hour time frame. We got a sharp move that went up there, right? It tells us that there is money there, right? But the way they moved there, they created some imbalances that are lying there. From this candlestick to this candlestick, right? There is some imbalance that are there. What can I do here? Maybe put another color there. Let me just put yellow. Oh no. All right, let me put it like this, like that, right? So this is an imbalance, right? If you haven't learned about imbalance, just check in the YouTube channel. You see lessons on imbalance, what it is and how we use it, right? So since we have some imbalance here, right, we actually expect that our price come lower than what? Lower than this point, right? So this was actually a church that we are getting there. As price got into that zone, this is actually a church. Remember, we talked about church in the previous lesson. This is actually a church that we got there. There is some imbalance. So our price should actually put, and this is liquidity. Below this low and that low, we are seeing that we have some liquidity, right? We actually have some equal lows that are there, right? So this is actually money, right? So this is a liquidity that is lying on this point. So this can be very, very attractive to price. It will actually attract price to come lower than these points at the same time to mitigate this order block that was left there, right? So what we can say by this from the 4-hour time frame is that we are expecting our price to come to mitigate this order block that is right at the bottom, right, before we actually get the final rise, right? So that's what we are waiting for, right? Let me put a gray color there, right? So we are waiting for our price to actually come in this zone from the 4-hour time frame. Prices to come to the zone, then we actually push to the upside like that, right? So that's what we have from the 4-hour time frame. We can wait from there. When price gets into the zone, we take a closer look on the lower time frames, then we get to trade, right? But for the sake of learning, let's also go to the M15 time frame and see what we have there, right? Maybe we have better detail that can actually help us to be precise on our analysis, right? So from M15 time frame, this is what we have, right? This is what we have, right? The church stands as it was, right? Then this liquidity, right? It will just stand as it is there, right? So now to fine tune our analysis now, right? We can now reduce our POI from the lower time frame. Lower time frames, they're actually used for finer analysis or for finer details, right? If you want to get the sniper entries, right? You can use the lower time frame, right? So this whole region, if you look at it, this whole region price was ranging, right? So you can take the whole region as a demand zone, right? To be safe, you just consider that whole region as what is your entry zone, right? But if you want that sniper entry, that best entry, since we have those imbalances that are lying there, you can also reduce your zone to that, right? And you can realize that your price can come just to that zone and you get some buys like that. But the disadvantage of this is price might want to just test this, right? Because you realize that from the 15-minute time frame, right, your POI or point of interest will be like this, right? They might just want to satisfy the 1-hour time frame POI. If you go to the 1-hour time frame, you will see that it's a different POI altogether, right, from the 1-hour time frame. So you realize that your price, yours POI will increase a little bit to that one, right? And if you focus on that only, you might miss the trade as well, right? So the best is you just get the whole range that you are seeing there from the lower time frame. This whole range, right, will give you the best entry zone, right? So when price taps into this zone now, you then do a further analysis, right, to get some reversal candlesticks, some reversal confirmations there, right? Be it some dodges, some engulfing candles, some hammer candlesticks, or some rejections that you know. Any entry confirmation that you know in that zone is what you'll use for your entries, right? So now it's just a time for us to be patient, very patient, right, for our price to start to correct. We don't know, they might push a little bit high, they start to correct from those zones, or they might just correct from those zones, right? So after the corrections, we'll pick our trades from there, right, and we'll be in that trade for swing trades, right? Remember, our analysis is coming all the way from the daily time frame, right? So if you look at the daily time frame, this is how it is like, right? You won't see anything. So let's just go back to the 4-hour time frame, right? So if you look at it from the 4-hour time frame, this is what we have from the 4-hour time frame. This is what we have, right? So let's just wait here. We'll wait for our price to correct, come back into this zone, then we get to take our trades, right? Remember, on the lower time frames, right, when they get to this zone, remember we've already done this from the 15-minute time frame, right? We just expect to see some engulfing candles, candlestick confirmations, right? If you want to learn more about candlestick confirmation, I will encourage that you look for a book that is called Candlestick Bible. It is a couple of candlestick confirmations that you can use for your entries. If you want to take entries, right, you can refer to that book and learn from that book, right? I think from what I've explained from this lesson is very, very helpful, and it will help you in your analysis and in your trading, right? So the entry that we're going to get there, right, the swing entry will be leading us to zones like that. So let me just put the projection there, right? Oh, sorry, this is a long trade. We expect to take our buy from that point like that. Then we should push all the way to that high, right? Just like that. This is the move that we're expecting from this top to down analysis that we've just done, right? So it's the same with every other volatility index that you want to analyze. What do you have to do? Go to the highest possible time frame. You start from there. Then you go to the lower time frame step by step as you observe what is there. The things to consider, right? Consider your structure. That is your PMS and your church, right? The next thing that you have to consider there, right? Consider your imbalances and your liquidity zones, right? Then you look at your supply and demand zones, right? From the higher time frames, then you shift to the lower time frames for your entry setups. For your entry setups, we are just looking at a church. We just want a church on the M15, M5, and the 1 minute time frame, like we are seeing there, right? The moment you see a church from there, you know that this market is already reversing, right? They have to tap your higher time frame zone of interest, then give you a church. The moment they give you a church, you just expect a corrective move back into those zones, then you're going to rise like that, right? So thank you guys for joining into this session and watching this video, right? If you are new to our channel, right, support us by subscribing to it, right? If you are also a constant viewer of my channel, right, thank you for that, right? Remember to share it to your friends, right? Thank you very much, guys. See you in the next session.